Hi everyone, this is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's joining us from Vancouver. He's a mining executive and he runs a private mining company. He's a mining industry consultant for the industry, and he's a follower of the Austrian School of Economics. David Jensen, thank you for coming back.
Good morning, Jason. I'm glad to be back.
So, David, you just put out a couple articles recently about on your Safe Haven website about a palladium shortage. Can you talk to our listeners about what this lease rate spike means?
Yeah. Well, basically, the reason I'm following palladium is it's the metal along with platinum, which appear to have the shortest above ground supply. And I was expecting these metals to show a shortage of the actual metal because they're trading these unallocated paper contracts in London. To give you an idea, of more than 200 million ounces of gold every day is traded in London, or what they call gold, but it's really unbacked paper contracts. And more than 2 billion ounces now of silver every day is being traded, again in this paper unallocated contract form. So what happens then is that you expect the real asset to disappear. And that's why and for the paper to remain trading on the exchange. And that's why I started focusing on the most rare metals in terms of above ground stock. Now the lease rate in London is a signal, and I think it's a good signal of the actual availability of physical metal. And so you can trade paper and you can hold contracts, but ultimately the users of palladium especially are industrial users, and they want the metal. They can't use paper contracts as a substitute for metal. And so I was tracking that palladium lease rate in London to see what the availability of physical metal was. To give you an idea, back in the 90s, there was a panic in the London metal market, and there's an inability to deliver physical palladium. And the 1 month lease rate shot to more than 300% per annum. To give you an idea of how panicked the banks were, who had been short the metal and unable to deliver the actual metal. And at that time, Russia stepped in and they had about 25 million ounces of supply, and they've been feeding that annually into the market. And that appeared to change precipitously in 2015 with a drastic drop-off in supply of Russian palladium, both mined and stockpiles, to the market.
Wasn't that palladium panic that you talked about in the 90s? That was a Ford purchaser, a manager there, who decided that they needed to have a long-term supply of palladium stockpiled for their cars, for catalytic converters. And then that was like the huge demand spike that really no one in the paper market saw was going to happen.
I'm not sure what the genesis of it is, but I do know that Dresdner Bank was in an absolute panic at the time, and they were calling for the U.S. to release platinum and palladium from its strategic stockpiles to solve their problem. And luckily for everybody, the Russians stepped in. Basically, Russia saved the U.K. paper metal market back in the 90s and has really been keeping it afloat since then. But I think with these aggressive policies of the neocons supported by the CIA and the US CIA and State Department, and by the UK MI6 and their Secretary of State, they've been basically intervening in places like the Ukraine, overthrowing the governments, and intervening in Syria and trying to overthrow the Russian ally there. So I think that it appears that the policy changed in Russia, and also the fact that the stockpiles had basically been bled down to that point at any rate. So there wasn't this great ability to supply gobs of metal to the market at that point.
I've researched the platinum and palladium market, and let's talk about the supply-demand fundamentals. And you can chime in if I'm missing something or I'm getting something wrong. I think the
Sure.
supply side for platinum and palladium, it's a byproduct of a lot of base metal mines like copper and iron ore. So it's kind of like silver in that respect, except it's even more rare to find in a lot of mines than silver is. And it seems like almost all the platinum group metals, platinum, palladium, rhodium, they come out of basically, I think, 3 countries. So I think the majority of the producers producing mines in the world come from Russia, like you mentioned earlier, Zimbabwe, and South Africa.
Yeah, palladium is about 40% Russia, and about 40% South Africa, and then 20% is the also rans. So I mean, Russia's annual mine production is of the order of about 2.5 million ounces a year, and it had been supplying about 3.5 million ounces a year, 3 or 4 years ago, into the market. And in 2015, that dropped down to 1 million ounces. And the 2016 exports, I am not able to source that data yet, but we can see that that the supply into the market has been constricted. And the way we can do that is looking at the import-export statistics from the UK, showing that there's been a continual bleed down in the UK palladium inventories over the last 5 years. And that both into Switzerland, there's been very little flow in and out of Switzerland. It's about a net zero. So there's no availability or real material availability of the metal from Switzerland, where it had historically been the center of palladium stockpiles. But the London Platinum and Palladium market, the director of that market notes that between 2009 and 2013, that the major stockpiles had been moved to the UK. And that's what drove me in that the paper I recently wrote there on Safe Haven about the market shortage. Drove me to focus on June 27th, if you want to look at the article on safehaven.com, and looking at the flows in and out of the UK, and we can see that basically there'd been a net draw by Switzerland over the last 2 years out of the UK, and the Russia had stepped in last year with 500,000 ounces, but both this year and previous years before 2016, Russia had played no real contributing factor into the UK market. So if that market is the major stockpile of global palladium, and there's been about 5.5 million ounces pulled out of that market over the last 5 years, and there's dwindling inflows into the UK at the same time that we see this spike in the lease rates, we can see then that there's no real availability of physical metal out of the UK, and that the stockpiles must then be greatly depleted.
When I researched platinum and palladium initially quite a bit a couple years ago, I saw down the road, I couldn't give an exact timeline, but in a few years there was going to be big supply problems, because a lot of the base metal miners, they have really bad balance sheets. They have brought on a lot of high cost mines. They had hedged their copper, iron ore, much higher prices. Those hedges were going to come offline. They had a lot of debt. So those miners were risking either shutting down those mines or going bankrupt. And there's huge geopolitical problems in Zimbabwe, obviously, with Mugabe still there. So that's not a politically stable place to mine. They don't really respect private property, so you don't have a lot of any foreign capital investment going into, upgrading mines and finding new mines and exploration capital to increase the reserves of the mines. The other thing is South Africa, Dave. Like now that the more stuff, I think South Africa politically is becoming a powder keg. And, despite the fact that a lot of the mines in South Africa have been running for a very long time, there's been huge depletion at those mines, so grades have fallen. Maybe mines that were once low cost and high grade, those mines, you can't really say that about those mines anymore. And it seems that despite that the miners are not making money at current metals prices, they're either close to bankruptcy or debating going out of business, the mining unions in South Africa are talking about either one, nationalizing the mines, or two, almost every year, despite the fact that the miners can't really afford any cost increases, the miners' unions down there are demanding higher and higher wages. So, in that scenario, it's not a smart move for really anyone to put any capital into South African miners. So I saw, when I looked at all these different things, and you mentioned the situation with Russia, and I think Russia has similar problems with costs and grades of their platinum and palladium mines. There's looming supply problems in the future.
Yeah, the metal coming out of the platinum group metals coming out of Russia, much of it's associated with nickel mining, but the platinum group metals coming out of South Africa, and I believe Zimbabwe as well, come from these primarily platinum group metals mines, platinum and palladium. And the price, I think the root of the matter is that the paper price that they've been setting in the UK, in London, which is the price that the vast majority of miners get paid, has been too low. They're setting it not based upon true price discovery and supply and demand fundamentals, but it's been set through an artificial trading process of these unallocated metal contracts for gold, silver, platinum, and palladium, the four precious metals. And so you're right. As a result of artificially low prices, the production structure in the mining industry is unable to produce enough of this metal, and they've been drawing down inventories to meet the gap. But I think what we're seeing now is, and you can look at the statistics in that June 27th article of this year, is that it appears that these stockpiles in the UK are gone. And so we'll see what happens. But Johnson and Matthey, who are the world's largest platinum palladium refiner, they warned us in their own statements, which were picked up by Reuters and picked up by CNBC, that you can't continue to run these deficits forever, and at some point the stockpiles are going to be depleted. And I think that's their polite way of warning the market that we're starting to see some hiccups. And they would well know. They've got two of their three global platinum group metal refineries located in the UK, where these stockpiles supposedly are located. So I think we're in for a change in the market. As we've seen in the past, though, that these things don't happen overnight. But when they do, it's a secular problem that you can't respond to, because it takes so long to bring a new mine onto production, even once you've found it. So you're looking at 7 to 10 years typically.
Yeah, so I think we've discussed the supply side for platinum and palladium. The demand side now, most of the demand is industrial, like you said. I think most of the demand, specifically besides industrial demand, is from catalytic converters, though, right? And those platinum and palladium, since they are normally expensive compared to other metals, and they are quite rare, they tend to be very heavily recycled compared to other metals. But in spite of that, there are so many new cars that are coming online, and everyone is trying to produce basically a more efficient, cleaner emissions car. And you need those catalytic converters on a lot of cars, especially in India and China. I think for many decades were not required. You could correct me if I'm wrong about that. So now they've implemented legislation recently, and they're trying to convert a lot of their older, more heavily polluting cars and trucks over there into what we have in the West with catalytic converters and emission reducers.
Yeah, they're having. I mean, you've seen the pollution problems in China, and they have to deal with that situation. So they are indeed using more and more catalytic converters now, and there's been a lot of talk recently about electric cars replacing internal combustion engines, but they're so inefficient in terms of their ability to turn, for instance, natural gas. From natural gas into electricity into motion of the car. You're only getting about 5 to 10% of the energy in natural gas converted into motion in a car, in an electric car, whereas in an internal combustion engine, you're getting about 20 to 30%. And that number is always increasing as they're making the engines more efficient, but you're getting 20 to 30% of the energy in gasoline. So, the green electric cars, if you want to do that in air quotes, they're not really green at all when you look at their ability to turn natural gas into motion.
Those are very interesting points you're making. I haven't researched that specific topic, but I know also a lot of the electric vehicles, they need a lot of rare earths, and China has a monopoly on those in terms of mining them at way below cost compared to every other country on the planet, and also processing the rare earths in the value chain. And if you want to look at how environmentally unfriendly China is about mining rare earths to get their monopoly on them, they've sacrificed a ton of environmentally responsible mining to have their monopoly on rare earths. The soil, the water, the air, all around these rare earths mines in China, there's lots of videos and articles about this, are totally destroyed.
Yeah, I mean, the rare earths are controlled outright by China now. It's interesting because America had a company called MagnaQuench, which was owned by General Motors at the time in the 1990s. And the Clinton administration allowed that to be sold along with all of their specialized refining technologies to China. And in the 90s, I mean, the U.S. produced about 20% of global rare earth metals, and were able to supply their, especially important were these tiny high energy magnets that are used to control the fins on their guided munitions. And what happened was that George Soros engineered a deal whereby GM would sell this strategic asset to China, and the Clinton administration signed off on it. It was signed off on actually by the Secretary of the Treasury, Robert Rubin, had to sign off on it. and that allowed the transfer of this critical technology to China. And then Molycorp was the primary mine in the States, and they shut that mine down using an EPA claim that the desert tortoises environment was being impinged upon by this single mine there in California. So it's just crazy what's happened in terms of the availability of these rare earth metals to the markets.
That's very interesting. I hadn't heard that story about the Clintons and George Soros, but I heard from a number of sources that around that time, even when Bill Clinton was the president, he was taking huge bribes from Chinese Communist Party officials and Chinese businessmen, and he was getting rich off that. So him and Hillary Clinton have been stealing for a long time. I want to ask you, though, about this palladium shortage with the lease rate spikes. Do you think then, we've discussed this in the past on our interviews, that the silver market is controlled and manipulated with paper prices, the same way platinum and palladium are, same way gold is? Obviously, silver is used a lot in industry, just like platinum and palladium. Do you expect to eventually see what's happening with palladium then, with the lease rate spikes, happen with silver as well?
Yeah, that's the end stage game, right? We're in the end stage now of the paper market for platinum and palladium, and I would expect next for silver, and then finally for gold to go, because there are the largest stockpiles above ground of gold relative to the actual annual flow. So the stock to flow ratio is very high for gold, and it's increasingly low for silver, and then down to the platinum group metals. So I would expect the platinum and palladium to break first, right? People start rejecting the paper and just say, give us the metal. You know, we're not happy. Just to give you a sense, I mean, the estimate is that there's 400 to 600 million ounces of spot claims, which is immediate ownership, sitting in the London gold market. And the estimate is 4 to 6 billion ounces of silver of spot claims sitting in the London market at the LBMA. Now, the LBMA won't release that data, but we have some indication of the daily volume, although the indication of daily trading volume in London is based upon a survey from 2011 of the major bullion banks, but only about 65% of them responded. But even with that partial response of their actual daily trading volume, the estimate is still well over 200 million ounces of gold trading per day, and now more than 2 billion ounces of silver trading a day in London. So the numbers are just right off the deep end. And I think the people that really need this metal, especially the industrial users initially, but I think ultimately the safe haven holders in terms of insurance companies and pension plans, etc., are going to step up and ask for the metal.
Now, I want to transition and ask you more about the gold and silver market, since you are a private mining executive and a paid industry consultant for the mining industry. I've asked you about this every time you come on for an interview. Since you live in Vancouver, you get a feel of the deal makers and the juniors out there, and get your opinion from what you've been hearing, the scuttlebutt there. So at the current metals prices at $12.45 gold, $16.35 silver, do you think the industry in general can make a lot of money? Are juniors raising capital now to do a lot of exploration drilling? Are we going to see a decent amount of new mines getting built at these current spot prices?
Yeah, in short, no. If you look at the GDXJ, the Van Eck Junior Mining Index, Gold Miners Index, it's down 65% roughly from 3 or 4 years ago. So the market, and it's flat. It had a little bit of a bump last year, but it's flat and declining. So, I mean, there is a little bit of deal flow happening, but usually with the small producers and the mid-tier producers, and almost nothing happening on the exploration side. It's a very quiet market right now. The prices have to go higher to stimulate exploration and development, and it's not happening with the paper market in England.
Yeah, I think we've had a bear market since I would say we had a little rally, you know, in end of 2015, part of 2016. That's looking like a bear market rally, and the bear market has been since 2011. So we've had a 6-year bear market.
Well, yeah, sorry for interrupting, but you have a bear market in the paper price, but at the same time, you have screaming demand for physical metal. I mean, if you look at 2013, 2014 in China, it just went bananas in terms of the physical demand. And the market is extremely tight on the physical side. And this is the difficulty, Jason, is that we look at the paper price and we draw conclusions from it. And all it's reflecting is the availability of paper, not actually of the metal. And we start using terms like, and this is not a criticism, it's just what people do. They look at the price, say, well, it's a bear market, it's behaving like a bear. But when you look at the actual supply-demand fundamentals for the metal, they're red or white hot. And so true price discovery based upon supply and demand is one story, and then price discovery based upon supply and demand for paper contracts, which are more or less unbacked by metal, is a completely different story. And that's the real problem here. Is I talk to people about the metals, and I encourage people with a long-term view of the market here to ignore the day-to-day price movements, because it really is. It's just I call it Indonesian shadow puppets. It's just basically shadows cast on a wall, and we're looking at it as if it's meaningful, and it's really not.
And there's real world ramifications for that, like we discussed earlier. So the mining industry now, because they don't have the profit margins, they're not generating free cash flow. They're not replacing reserves adequately. They've cut costs to the bone just to delay bankruptcy. They've high-graded some mines, so they've destroyed long-term the project economics of the mine. But yeah, you're right, exactly right. I completely agree about the divergence between the paper markets and the physical markets. Physical demand for gold and silver in China and India are very strong. The American investor tends to chase prices higher. They're chasing a lot of retail U.S. investors. Dave, I'm not sure if you're hearing the same thing I am. But on my podcast, in the comments section, a lot of people who contact me on social media or in emails, they've given up on gold, silver, and mining shares because of this paper bear market. They've liquidated all their gold, silver, and mining shares, including physical metal, and they're started chasing Bitcoin and Ethereum and all these altcoins higher because they admit, it's cheap, it's undervalued, it's going to go up eventually, but they can't take the pain anymore, the mental pain. So it's a really interesting market, and I think, like what Jim Sinclair said years ago about how the people manipulating the market would end up being the ones making the profit because the retail investors would end up giving up.
Yeah, I mean, retail investors are following the Kitco price, if you want to call it that, the paper market price. And my personal view is that Kitco is part of the problem because they don't do any real in-depth investigation, in my personal view, in what's going on in the market, the physical demand. And I was buzzing through a few websites today, and I saw a headline there, and I'll just read it to you. It says, 44-year market veteran says retail panic selling now taking place in gold and silver markets. Well, so that identically reflects the point that you made there, Jason, is that people are just desperate to get out of these metals, not realizing the fact that what they're taking their cue from is a completely manipulated market.
I agree. I think there is a retail panic though in the U.S. So if you have been accumulating gold and silver for years, a lot of U.S. retail people. I heard a story from the guy on Silver Doctors, John over there, and he has a bullion dealer now, and he said that one client, normally you would break up if you were going to sell some metal, you would break it up, but he said the guy liquidated $3 million worth of silver and wanted to put it all in on Bitcoin. So, and look at the U.S. Mint number. So that reflects middle class people. Maybe they're bullish on Trump. Maybe they think Trump can fix everything. But they've given up.
They're also getting sucked in by the cryptocurrency story. And I'll just tell you, my view of cryptocurrencies is that they're a scam. And the reason is it's not that the coding is not good, or there are problems with the ability to create more of these coins in each individual type of crypto coin, that there's different loopholes that can be used. But the real issue for me is that there's nothing there in terms of underpinning the value of the coins themselves, number one. And number two is that you can create thousands. There's over 600 crypto coins right now, and you can create tens of thousands, and they will create tens of thousands of these coins, and it's just going to be just a complete gong show in terms of, well, what is this, right? It's very much like tulip bulbs, right? It's just something that has been seized upon as potentially having a great deal of value, but when you look behind it and just say, well, is there inherent value? Is there intrinsic value here? In terms of the asset itself, and I don't see any intrinsic value, but it's people are very excited about blockchain and the ability to have digital this and digital that, and it's really, really unfortunate because it's completely sending people, in my view, down a cul-de-sac.
there's a lot of people in the United States that just love technology. So anything that has is mostly technology or technology related item or a technology company in the United States seems, in my opinion, to get a much higher valuation than, you know, regular business that can grow revenue, grow earnings, has strong margins, can generate free cash flow, pays a dividend. A lot of people look at that as, it's boring. And so a lot of technology companies, even like look at Snapchat and Netflix, I mean, and even Amazon, a lot of these and Tesla Motors, these companies, their balance sheets are bad. They don't generate any free cash flow, and yet the share prices soar like crazy. Even if they lay an egg on earnings, you know, they totally bomb in earnings and the share price doesn't collapse. People buy the dip and the stock price is up. So this is just irrational. A lot of the same behavior that happened in the technology bubble in the late 90s, early 2000s is starting to happen again. But I want to ask you about, and I think also with these initial coin offerings, David, which are the Ethereum blockchains being used for those, there's a lot of fraud going on in the initial coin offerings, and none of these ICOs or tokens have gone to zero yet, but in the future they will. So I think, you know, I'm a libertarian. I know you're a libertarian, Austrian School free market guy, but I think the reality of the situation is that the regulators, when people start losing money, they're going to hire lawyers, they're going to write letters to their congressmen, they're going to go to the Securities and Exchange Commission and say, you need to regulate this. You know, I'm not in favor of regulation, but I'm just aware that, you know, when people lose a lot of money, that's what it's going to happen. But I want to ask you now about the mining industry. Do you think that gold and silver miners over these last 6 years in the paper bear market, do you think they've cut pretty much all the costs that they can cut at the mine, you know, at running their business? Are there more costs to cut? Or if, let's say, the paper manipulation knocked gold to 1,100 or 1,000 temporarily, or knocked silver to 13 or 14, do you think there's more costs these guys can cut, or do you think that's basically about it now?
Yeah, can I just finish up on one point on Bitcoin before we go? And
Sure.
And now I'll circle around to your next question. But if you look at Aristotle's 4 characteristics of money, the one that I think is critical in terms of identifying where value is the concept of intrinsic value, and that was one of the 4 must-haves that Aristotle identified for money to be money. And this is what I think knocks Bitcoin and blockchain and bit whatever out of the running, is that there's nothing real. There's no real asset there. There's nothing that has intrinsic true value. And that's what I think dictates ultimately that Bitcoin and fiat money and all the rest of it go to their intrinsic value, which is zero. So I'll leave it at that.
I agree, but if you can make money speculating on cryptocurrencies, David, and then buy real like gold and silver or real estate with that, if you can trade and speculate, I wouldn't keep my money in the cryptos, but if you can trade them and make profits, take the money out and buy real stuff with it.
Yeah. No, I'm sure there's guys named Jason out there doing that every day, right? Making dough in that market and then able to roll the profit into real assets. And that's definitely an approach. For me, I'm just a little bit more, I'm just so reserved in terms of looking at those assets and just feeling like you're standing on a trap door and when's the trap door going to open, right? So, there's definitely an opportunity to make money while the speculative fervor is going. There's no question. It's just for me, maybe it's the engineer in me, but I just look at it and just go, man, this is crazy. I don't want to stand on that trap door. So, personal view.
I already traded Ethereum and I made some good profits. I sold too early, but you know, I had like 9-10 full gains on my position, so I can't complain too much. But sure. But I want to ask you. I'm probably just gonna buy silver with those profits. But now I want to ask you, re-ask you the question about the mining industry. So do you think they've basically run out of ways to cut costs at the mines? Do you think this is it? If the manipulators were able to knock the price down, that the mines would either close or miners would go bankrupt?
Yeah, I think you just look at the stock charts. I mean, even look at like a company like Goldcorp. They've gone nowhere for more than a decade. They're just holding their nose at the waterline. You know, you knock the price down much more. I mean, the thing that kills me about these miners is that they're happy to take a paper price with what I view as fake price discovery, and they're willing to swap their shareholders' gold in the ground, to go to all the effort of finding it, mining it, refining it, and then ship it into the market for a return of zero or negative return for their shareholders. And I think that in the end, the shareholders are going to just lose it on these companies who have been shipping their assets into the market. And we are at the point. I mean, South Africa. Just look at South Africa. Their mine production. I think they do it on an October to October basis. But the last time I checked it for 2016, that their output of all South African mines was down 12%. So you get that kind of drop off because the price is just not there to support the expansion. And many of the platinum mines in South Africa are running on a negative cash basis of operation. Never mind amortizing the exploration and development and the cost of building the mine, but they're running negative on their cash flow, and that's why these platinum and palladium stocks have been so beaten up. So yeah, we're getting close to the limits of how these mining companies can continue to raise capital and continue to operate.
Yeah, so I think the producing miners can raise a little bit more debt or equity and maybe buy themselves a little bit of time. But from the other people I've interviewed as well, they say the same thing pretty much that you said, that there's not really any more cost to cut. That it's I did a short video about this a week or two ago, that Coeur d'Alene, they're known in the industry as a much higher cost marginal gold and silver producer. They've cut their cost 26%.
Yeah.
Over the last couple of years, but it took them from 2014 to the first half of 2017 to do it.
Yeah.
So, yes, it's impressive they've cut their costs that much, but I think people out there think that the miners can cut costs very quickly, and it took Coeur d'Alene almost, over 3 years in order to cut the cost that much. And, they can't really continue to cut the costs like that without the mine, all their producing mines starting to make huge losses or them going bankrupt.
Yeah.
Balance sheet.
No, I all I can say is I agree. It's just we're at the limits now.
Yeah, I've almost gotten to the point, David, where if the paper prices are manipulated, I think it would almost be like almost a risk-free trade to go out and buy like 100-ounce physical silver bars, take delivery of those things, and just sit on it for a year or two as a trader, and eventually the price 2 or 3 years from now is going to have to be up 20 to 50%, or 30 to 50%, just so that way the miners can start, replacing their reserves, maybe increasing production a little bit, spending money on exploration. I think it's almost guaranteed that 2 or 3 years from now we're going to have 25, 30 silver, 1,400, 1,500 gold. I just don't see the miners surviving without much higher prices like that.
Yeah, and it may not even be so much on a price basis, but on an insurance basis. And the reason I say that is Canada's introduced now some bail-in legislation, which is notionally going to be voted on in October to bring it into play, to have banks exchange their debt for equity. It's interesting because the regulations in this new act specify that it doesn't apply to deposit holders, but by putting it into the regs can be changed by whomever is assigned to change the regulations. It doesn't have to go back to the Parliament of Canada again. So, I mean, I looked at the balance sheet of the banks here in Canada, and they hold about 1% of their deposits in cash form, about 10% in government bonds, and the rest of their assets are loans. And so, 1% of the people are going to get their money, or 100% of the people are going to get 1% of their money, or somewhere in between. But it's so unstable. So yeah, there's an opportunity to make money by buying real assets, and I think that the critical thing though is there's an opportunity now to insure yourself against what I think that even the governments are starting to advertise through their movements of what's going to be an upcoming bank crisis.
Yeah, that's an interesting point you brought up about Canada. I know I've seen the stories on Zero Hedge and elsewhere about a housing bubble in Canada. I've been up to not Vancouver, excuse me. I've been up to Toronto a couple times in the last few years, and just the amount of building they're doing there with very high-end condos and new, commercial real estate buildings, there's enormous amount of building there. And I've seen a documentary in Vancouver about the Chinese putting a lot of money there into empty houses, basically, and not even going over there and living in the houses. They're buying these things for over $1 million sight unseen. And so now there's, I think, like a vacant house tax that Vancouver politicians just put on. So, they're going after Airbnb. Anyone who's making money off that, they're putting a tax on those guys. and now they're taxing us. So, and I think the other thing is with Canada is you guys have really high like home equity loans and second mortgages. I think there's been huge spikes in credit card debt and home and those types of home loans from Canadians in the last few years.
Yeah, total debt here in Canada is about 400% of GDP. When you look at federal and provincial and municipal, consumer, corporate, so we're running about 400% of GDP. The States is about 340, and the historically balanced level was about 150% of GDP. So, I mean, people that talk about Canada being some model of opprobrium is ridiculous. I mean, we are in severe straits here. And this housing bubble action that we're seeing in Canada and to some extent in the States is just basically a replay of the 1920s, where we had a crazy, North American real estate bubble run by loose money. There's nothing new in that story.
Yeah, if I could have one last point before we transition to, you wanted to talk about the similarities between what's happening now in the 1920s. I was up in Toronto last September, and I had BNN, which is the Business News Network for our listeners who are not familiar with it, the top like business channel in Canada. And every 5 minutes, David, they were running like home equity loan commercials and second mortgage commercials. I was like, what are they doing?
Yeah.
This doesn't make any sense.
No, it's crazy. And they're I mean, there's advertisements on the radio here in Vancouver for people to buy bonds with these home equity lenders, and the bonds are paying 8% return, which gives you an idea of the risk profile of the people that are borrowing that money, because they're paying a 10 or 12% interest rate on their home equity loans. So it's crazy what's going on.
That sounds like prior to the 2008 housing crisis in the U.S. with, securitizing subprime and putting it into tranches, and then the banks were dumping that stuff off their books and dumping it on pension funds and those types of sucker investors as fast as they could.
Yeah.
Well, let's talk about what you think are similarities between what happened in the 1920s and today. Today the global macro picture, all the asset markets are not reflecting reality, in my opinion. Stock market is over Dow 21,000. Real estate prices are in some cities, David, they're above levels that they were in 2006 and 7. The bond market hasn't crashed yet, although a lot of people have been calling for it to crash. It hasn't crashed yet. So what parallels do you see between the 1920s and today?
Well, I see the primary issue here is that the secularly declining interest rates, and it's been enabled. Larry Summers' paper there in 1985 identified that a rising price of gold was an obstacle to a secular drop in interest rates. So Summers wrote that paper in 1985 with Barsky, and in 1987 the Bank of England created the LBMA, which is a paper gold market. And basically since 1987 we've had artificial gold pricing with a fake price discovery and secularly declining interest rates, and they've gone from roughly 15% in the early 80s down to 0% now. Similarly, in the 1920s, we saw this drop in interest rates, and the housing and stock markets go crazy. It's interesting because the Federal Reserve dropped its discount rate from about 7% in 1920 down to about 3% in 1924. And that stimulated a lot of activity, borrowing and activity in the U.S. And interestingly, in 1925, Chancellor of the Exchequer Winston Churchill repegged the British pound to gold, and he set the rate at too high a rate. It was artificially strong, and that caused a outflow of gold out of the UK. And so what they had a deal with the Federal Reserve was that the Federal Reserve would maintain a lower interest rate to make the U.S. less attractive for these outflows of UK gold into the States. But what that low interest rate did, they started to raise interest rates in 1925 in the UK, while America kept them artificially low. And that's what drove the stock market crazy for those last 5 years, and the housing market. I mean, mortgages in the U.S. in the 1920s increased eightfold, so 800% increase. in outstanding mortgages, and that's what drove the property bubble in the U.S. And there was all kinds of financial engineering, if you want to use Alan Greenspan's term, going on. But the bottom line is it was a speculative boom driven by artificially cheap money. And similarly today now we've seen the Bank of, well, not the Bank of England, but the LIBOR, the London Interbank offering rate, which is the overnight rate for the banks that they lend to each other in London and over longer periods as well, for that matter. But that interest rate started to increase in 2014, and it's increased since. And the Federal Reserve has now belatedly started to raise its interest rates as well. But we can see now that there has been this enormous debt bubble blown with you want to use the term fake, but artificially low interest rates enabled by the paper gold market. And now that we've blown this enormous debt bubble, and the total U.S. outstanding debt is, according to the Federal Reserve, is $66 trillion on a federal, state, corporate, consumer, etc. basis. But the whole entire ball of yarn in the States is about 66 trillion, and they're raising interest rates now. Now, for every 1% that you raise interest rates, that's $660 billion of added interest payments per year that gets sucked out of the real economy. So there's a tax. It doesn't matter what Trump does in terms of trying to increase efficiency. The Federal Reserve and the Bank of England are increasing interest rates, and they are sucking money out of the real economy at a time where the real economy is completely completely dependent on 0% interest debt. And that is the similarity that I see, is that they both ran interest rates down, and then the UK banks initiated the increase in the interest rates with the Federal Reserve following, and now we're approaching the terminus point of this horrifically large debt bubble that's been blown.
Yeah, Trump inherited an enormous mess from not just the Obama administration, but this has been building for decades, really. And do you think then that the central bankers who are now talking about raising interest rates, Mario Draghi over at the ECB, I think he may leave in 2018, but he's been talking about reducing their QE. There's been an enormous quantitative easing program that the ECB, Bank of Japan, Bank of England have picked up, where the Federal Reserve was supposedly decreasing their quantitative easing. And so in 2017 alone, over 1.5 trillion in QE programs have gone into asset markets to buy corporate bonds, government debt. I think that money is leaked into the stock market as well. So do you think then that they intentionally want to crash asset prices, or do you think they really don't care then? And why do you think they're raising interest rates?
I don't know what their motivations are, but they can see, and we can see, that they are going to collapse the debt bubble. That's all I know, is that there's been a multi-decade debt bubble blown. The economy now is dependent on 0% interest rates, and they have started to move. The LIBOR rate started to move in the end of 2014, and the Fed rate and the Bank of England's overnight rate are rising now. And the Bank of Canada, for that matter, is joined in. So you blow a multi-decade debt bubble and you create a completely falsified economy dependent on 0% debt, and then you start to raise the interest rates. There is only one result out of that, and that is a distorted, debt-addicted economy is going to crash. And why they're doing it, it's difficult to say, but they know well what they're doing, and they know well what the results are going to be. There's no mystery there.
This could be politically connected because, if Hillary Clinton had won the election, I'm not sure if the Federal Reserve would be raising rates. But everyone pretty much agrees that all the elites in power, the economic and political elites in power, all the globalists hate Trump. And Trump, I think stupidly, because, during the campaigns, he was saying the stock market's a bubble, the Federal Reserve's been manipulating interest rates. I agree with him. It seems that was just rhetoric, but at the time, when he said it, I agreed with him. And maybe he was just saying it in order to get votes from people. I didn't vote for him, but, maybe it resonated with people who are on the margin, and they voted for him because he said stuff like that. But, now he's taking credit for the stock market rising. I think that's a mistake. I think, the people in power, you cannot, I don't think it's possible for them to keep raising interest rates, claim that they're going to start, global central banks have 18 trillion in asset purchases that they've done since the 2008 financial crisis. Basically, I don't think that they can raise interest rates, sell a lot of assets off the total combined global central bank balance sheet, and then still keep the asset prices high. I just don't see it.
No, the question for the Federal Reserve is, they say they need to raise interest rates. The question that I would ask is, why do they need to crash the economy? Because that's the ultimate result that comes out of it. What needs to be done is a structured write-down in outstanding debt in terms of its value versus the productive capacity and the output of the economy, and a reinstitution of sound money to stabilize the economy. But that takes away the franchise of the financial sector, basically to run a central bank which spins out of control and runs the speculative markets out of control. It's a lot of fun when you can do it, and you can also finance a massive, although temporarily, but you can finance a massive military industrial complex as well. But the question for the Fed is, why do you need to crash the economy? Because that's what they're going to do.
Yeah, that's very interesting. And also, the interest rate should have been raised a long time ago. The Federal Reserve, when Bernanke was still there years ago, they had promised that they were going to raise them. So, I mean, they should have raised them a long time ago. Not that anyone should have control over raising the interest rates. I'm anti-central bank. But, it seems like unless they're doing this intentional, that all these central bankers, all these Keynesian central bankers, are always making the wrong moves and making things worse. Even though that no one calls them out for all their screw-ups. Look at what Ben Bernanke said about the housing bubble in 2005, 6, and 7, how subprime was contained and all this. No one calls these guys out on their bad. Janet Yellen has just as bad, if not worse, of a track record. She had no clue about the housing bubble, and she was the San Francisco Fed chairman.
Or she said she did, or she said she didn't. And the thing is that nobody is calling out Ben Bernanke, for instance, on outright deception. I mean, he said that in that interview just prior to the housing bubble collapsing in 2007, he said to Maria Bartiromo on CNBC at the time that there had never been a decrease in house prices in the United States. Well, in the 1930s, house prices in dollars dropped by 30%. And Ben Bernanke is a student of the Great Depression, and he knows that the house prices declined 30%. Now, if you say that they were in a deflation and you adjust the deflationary buying power of the dollars, then the house prices did not drop in price any more than the average basket of assets did. But the bottom line is that your mortgage is not defined in deflation adjusted dollars. It is defined in dollars, and at that time especially, the dollars had buying power, and the people that sat in mortgages, basically the housing market dried up, but the average house price in the United States dropped 30%. There's a question for Ben Bernanke. I mean, I don't believe the story that they're bumbling fools and are not sure what they're doing. They're very deceptive.
And Janet Yellen said recently that there won't be any more financial crises in her lifetime. I think she's saying that to keep the asset markets high until she's able to leave the Federal Reserve in February or March of 2018, so she's not the bag holder, and either Trump or whoever comes after her as Fed chairman will get blamed then.
Well, she said her lifetime, so nobody knows the condition of her health.
Oh, I thought she said she was talking to the whole audience she was speaking to and the person interviewing her, and she said our lifetimes. So I think she was confident. She was saying that they've figured out how to stop financial crisis in general. I mean, that's kind of the hubris, though, that Keynes had. How when Keynes came out with his theory, his crackpot theories, his main book, The General Theory, and so he said basically that he had solved the business cycle. So that there wouldn't be any more recessions or depressions, that Keynesian economics had created a perfect cyclic economic measures with interventionism, and it solved the business cycle. Yep. But yeah, the 1920s were a very interesting time. There's a biography about Ludwig von Mises talking about some of his comments. I'm reading it actually now from the Mises Institute, and he was talking about then how back to Churchill. Also, I read the book from Jacques Rueff, who was involved in the French finance ministry then at that time. And he wrote a book called Age of Inflation. That book's free. It's a PDF. It's an ebook now. And so, you know, those guys, you know, they were talking, they knew World War I had basically bankrupted pretty much all the European countries. And so they couldn't pay back their debt. They all want to inflate, essentially. But they knew that if they inflated like crazy, people wouldn't trust their government bonds and their other obligations. So they kind of went back to a partial gold standard with the gold exchange standard, where either people could have gold as reserves or they could have paper currency as reserves, and it counted the same. And so then that's when you also got all these money and credit bubbles, because you know, people were multi-counting reserves and leveraging that up, and they set the gold price then at way too low of a level. So it's very common throughout history, modern history, whether it's Bretton Woods or the gold exchange standard after World War I, is the gold price is always set by the central planners, the politicians, and the central bankers in power. The gold price is always set at way too low of a level, given how much money and credit has been created in the system.
Well, one thing to note, I agree that central planning doesn't work, but the other thing is it gives sociopaths access to levers of power. And one thing to note about Winston Churchill, who pegged the pound at too high a level in 1925 when he pegged it back onto gold, and raising interest rates in the UK and forming an agreement with the United States to keep their interest rates artificially low, was that Churchill resigned as Chancellor of the Exchequer in 1929, and he traveled to the United States by steamship, and he was standing in the balcony of the New York Stock Exchange in October on the day, I forget the exact date, but it was in October of 1929, observing the chaos at the New York Stock Exchange. So I don't know about the motivations, you can only guess, but it is fantastic to me to see a person so central to the artificial manipulation of interest rates, especially in the United States, just happening to be on hand to observe the singular date of maximum panic at the New York Stock Exchange.
That's very interesting. I would actually, you know, favor a free market for gold and silver, no manipulation or intervention. Actually, one of my friends heard Gary Gensler say before he left the CFTC, admitted that gold and silver were very heavily manipulated, and then he claimed some bullshit excuse that, oh, we don't have the money or power or manpower or resources to stop the manipulation. But yeah, instead of a gold price, you know, during the next global financial crisis, if they move the gold price higher and then try to put windfall profits tax or something, I would be against that. I would rather see a real free market gold price, much higher gold and silver prices. But, you know, the people in power, they're going to blame. I don't think they want that. So it's going to be a fight with ideologies, unfortunately.
Well, Gary Gensler was the chief financial officer for Hillary Clinton's presidential campaign. Yep. So I think that speaks volumes in and of itself as well.
Yep. Did you read Jim Rickards' new book that came out a few months ago? Did you?
I haven't, no.
Okay, he actually puts in a story in there how when Gensler was a director for Goldman Sachs and how he went through long-term capital management's books because the long-term capital management was in trouble and they were trying to get Goldman Sachs to raise capital or invest in them for like a bailout. And Gensler looked through some of their derivatives trades and got inside information in there and made Goldman a bunch of extra money. And Goldman didn't do the deal then with long-term capital management. But the rest of the Wall Street banks, you know, coordinated a bailout. And Bear Stearns was one of the main banks that didn't want to get involved in helping bail out long-term capital management.
Yeah. Well,
it's all, you know, these politicians and these high finance bankers are connected. It's very incestuous.
Yes, it is, and I think that, you know, what used to outrage me 15 years ago, you almost become inured to it.
Yeah, I agree. I'm getting fed up with debating a lot of the Marxists and socialists and Keynesian people because, you know, they haven't even read any of our arguments. So it's getting kind of ridiculous even trying to argue with them anymore. I just like if they start like sending me a lot of garbage on Twitter, I just block them now.
Yeah. Well, the bottom line is that pirate capitalism doesn't work, and it's what we've had for the last century with our central banks, and it's time for a new system that's much more stable.
Agreed. And in the 1920s, there was also a lot of wage and price controls. Herbert Hoover, before he left and was voted out, started putting them in. FDR put them in as well when he took over after Hoover. And Congress was on board with interventionist central planning economics as well, because, you know, they put in Smoot-Hawley, which was trade wars and high tariffs, and that hurt the economies like Germany and Japan even further with trade restrictions. So that made things even worse. It exacerbated the problem. And Trump's been talking about tariffs as well. So hopefully he doesn't do that. But, you know, with the mess he's inherited, he's kind of, historically, he may end up being like Herbert Hoover.
Yeah, he's going to be, as Hoover was tagged with the fault of the Great Depression, which was really resided with the central banks. Trump will, I believe, almost assuredly be tagged with blame for the Great Depression, despite the situation having been created by market intervention and disconnect of critical warning indicators like the price of gold, warning of inflationary monetary policy. They basically just shut off the warning system and then ran the reactor at 150% of output, and just marveled at how the warning systems weren't responding anymore. And that's what happened with the creation of the LBMA by the Bank of England in 1987. And we've been basically running our monetary policy with the warning systems shut off. And there's a reckoning as a consequence.
I think that's what the elites wanted. I mean, people in schools, David, don't learn even how to balance their checkbook. They don't learn any personal finance. They don't know what real money is. That's intentionally taught that way, that they don't learn how to be good investors or learn, you know, basic personal finance skills. So most people, if you took a microphone, or if I took a microphone, rather, since I'm here in the United States and you're in Vancouver, if I took a microphone and I walked around Washington, D.C. for a couple hours and filmed it and started asking random people who Janet Yellen is or who Ben Bernanke or Alan Greenspan is, I guarantee you probably only 1 or 2 people out of 100 or even out of 1,000 would know who they are.
Yeah. No, they're watching reality television or something else.
Well, yeah, they're watching sports, or they're watching like celebrity gossip or things like, or MTV. Yeah, they're into other things that are more fun.
Yes.
But before I let you go, you were telling me about this very interesting junior mining stock that you think our listeners should research. So just very briefly talk about the company and maybe why they should research it more.
Well, it's one that I'm following closely. I'm not giving investment advice. I'm just talking about a mining company that I find intriguing. And the reason I find it intriguing is for the potential scale of what they're working on, what they're chasing down. And Quinton Hennig worked at Newmont Mining, and they had a team put together to find the next Witwatersrand, or as the South Africans call it, the Wits, with a V, not a W. And I mean, the Witwatersrand produced 1.5 billion ounces of gold, or about 35% in round numbers of total global gold production throughout history. And what Quinton Hennig, the CEO, who is a PhD in geology, came up with was looking at Western Australia. And there's lots of video on YouTube of prospectors with metal detectors pulling, you know, up 5 ounce and greater gold nuggets out of the red dirt there in Western Australia. And so he's come up with a model of an ancient seabed which had gold deposited on the bottom, and it was from ancient plant life, basically leaching gold or precipitating gold out of seawater. And then the gold would aggregate with carbon on the seabed, and ultimately, as the continent was raised, the ancient sea drained, and from the ancient shoreline, the rivers flowing into the old sea would aggregate the gold into a placer form. Now, there's a technical report on Novo, and Novo's trading symbol is NVO, or November Victor Oscar. On the Vancouver Exchange, TSX Venture, I guess it's called. I encourage people to read the technical report there, because he talks about the genesis of this model. But the rock package in Western Australia is multiple billions of years old, just like the rock package in South Africa is. There's a very similar ancient rock foundation there. And so what he's seeing there is in the aggregate, in the compacted aggregate rock that they're finding now, these nuggets of gold from these ancient channels that were flowing at the time. So anyways, what makes it so stimulating or interesting for me is the scale of what he's talking, because if you're talking another Wits or another Witwatersrand style basin in Western Australia, it could be 1 billion ounces with a B of gold production over the next decades that's going to come out of that area if he is right. And what he's finding right now is extremely large nuggets, and they're homing in on an area which looks from their news releases to be one of these what they call the gold leaders, which is the concentrated high grade gold that are in these channels.
That's very interesting. Now, you mentioned to me that a lot of this news and technical reports have a lot of geologists interested. So it doesn't sound like one of these juniors that's marketing only. That's not drilling. This is a very technical guy.
Yeah, there is a lot of interest rising in the geology world about this project because of the scale. Every geologist knows what the Wits is, and it's kind of the holy grail of gold. And the fact that they are looking at one now that they think could be the next great one is really interesting. It's also interesting that Newmont, as a major, owns 15% of Novo Resources stock, but that Novo just signed an MOU with Sumitomo to develop its assets. Now, an MOU is non-binding. So it looks to me what they're doing is, and I think this is a very intelligent approach, is that they are trying to get as many eyeballs of major sources of capital on them, focused on them, to ensure that there's a proper bidding war. That's the only way you get proper recognition of your assets. So that is a very intelligent move if that is what they're doing. You do want to stimulate a bidding war of the majors. You don't want they're trading at about $1.60 Canadian in round numbers, and you don't want a $2 offer from Newmont. And for the accretion of the vast majority of the value of this asset as it's developed, if it's what they think it is, you don't want that to be diluted into Newmont shareholders' hands. You would like your own shareholders to have the best ride.
The stock has already doubled in the last 6 months, although, it's been volatile because it's a junior miner in the last couple of years. Have they actually drilled off a lot of this land package yet, or are they still just raising the capital to start drilling?
They're trenching right now. They are going to drill, but they're trenching. The ancient seabed outcrops that surface. And so what they're doing is they're trenching. And by the way, it's doubled in about the last 10 trading days as the news releases come out. But what they're doing is that they're trenching and recovering this high-grade gold nuggets in the conglomerate that they're finding. So I would expect that because it's near surface, what they're doing, and it's very visible in terms of the large nuggets, I would expect that they're going to continue to trench and that we'll continue to see news flow out of them. So I'm watching their news releases very closely to see how it's developing. But yeah, this is a virtually unknown stock in the mining world, but in the geology space right now, there is a lot of attention being paid to this.
Sounds very interesting. And I will put a link to the company's website, Novo Resources, for our listeners to. I'm not endorsing the company in general. I don't buy junior mining stocks anymore. But I will attach a link to the company's website for our listeners out there who want to go and do their own due diligence on it. Yeah. Well, David.
Sorry, one nice thing about this is, as they're developing this asset, is that they aren't dependent on the daily price of gold to have recognition of the value of their asset, given the scale that they're talking about. So that's one very nice thing, is that they're not going to ride it. My perception is that they're not going to ride the daily price of gold up and down. It's more a question of executing on their model and developing the asset.
Yes, and if it is indeed a really large discovery of many millions of ounces of gold, majors would obviously be very interested in that, because it would be a large mine, multi-decade, potentially district there with multiple mines. So that's the type of thing that the majors need right now, the gold mining majors, because they have a huge problem replacing a lot of they've mined so much gold even during the bear market, that they're really struggling to replace their reserves.
Absolutely.
Okay, David. Well, I enjoyed our discussion. I always do. You know so much about mining and Austrian School of Economics. And if our listeners want to follow more of your work, how do they do so?
My articles are posted on safehaven.com. If people want to get in touch with me, I am in LinkedIn. Feel free to contact me if there's questions. But yeah, that's the primary spot is safehaven.com. A few others pick it up sporadically, but my articles have all been posted at Safe Haven.
And I'll put a link to your latest article there in the info section of this interview about the palladium market. But thanks for taking the time to talk today. Very interesting things about the palladium market. Hopefully in the near future, we can see something very similar happen in the silver market.
Yes, thank you for your time, Jason.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.